Does part of navigating your financial journey include trying to find the perfect portfolio? It doesn't exist, but your perfect portfolio does. Check out this episode of Wealth on the Move, the podcast, where I interview author of Your Perfect Portfolio, Cullen Roche, and we talk about how to make sure your portfolio is matched for what your needs are. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management, and I'm really excited for today's episode. We have Cullen Roche joining us, author of Your Perfect Portfolio. And the key word I think that Cullen's going to factor in that title is your, not the perfect portfolio, your perfect portfolio. But in lead up to this call, Cullen and I had a lot of similarities around this profession. We see the world through the same lens when it comes to managing money and helping our clients. And I'm excited to hear what his motivations were for this book and share a lot of ideas that he had. So without further ado, Cullen, welcome to Wealth on the Move, the podcast.
Hey, Will. It's awesome to be here.
I'm excited, man. We had a lot to talk about in our intro call, and I'm excited. So first, before we get too deep into the book, tell us a little bit about Cullen, your background, and what you're up to right now.
Yeah, so gosh, I grew up on the East Coast. Actually not too far away from where Will is in Pittsburgh, and I got into the asset management business and financial advisory business starting at Merrill Lynch. So started with a big firm, big team. I was kind of the grunt on the team, and we were doing this is 2 decades ago. So I was doing old school stock and bond picking, and we were kind of slinging positions for commissions and pretty old school. And
Yeah.
I didn't love that business model. So I spun off after a few years. In retrospect, probably a stupid move, or a little too eager, I guess, when I was that young to be leaving as quickly as I did. But I managed to cobble a business together over the years. And so I've been independent. I've been an independent RIA for, almost 20 years now. And I've traversed 2 different worlds, because when I spun off, I structured my business as a limited partnership. And so I was really more portfolio manager than financial advisor at that point.
Okay.
But over the course of my career, I have been doing more and more true financial planning and more financial advisory work by necessity, and because my clients needed it. And so I've traversed 2 very different worlds here, where I'm part portfolio manager. So I'm wearing the portfolio manager hat, but I'm also wearing the financial advisor hat. And these 2 worlds, they don't always play nice together. And especially from a business operations perspective, I always wanted to construct portfolios that would make my business more streamlined. That would be easier for me to manage, just from a management perspective, where I could sort of plug and play a certain style or strategy. And the thing that I found over the course of my career is that it's not that simple. You can have a model portfolio, and the model portfolio always has to get customized to some degree. And so, because everybody's different, and that's one of the main gists of the book, is that you can't just find a strategy that somebody else is selling or promoting, or that maybe appears like some sort of holy grail strategy that you saw on financial media, and then try to jam this square peg into a round hole.
Right.
And that's the problem with, I think, a lot of portfolio management, is that people, a lot of the times, they will jump from strategy to strategy to strategy because they fall for the sales narrative of a strategy, or they read about how fantastic this thing was in some sort of back test or historical performance perspective. And then they realize over the course of actually implementing it in their own life that, hey, this for some reason doesn't actually meld with my personal needs and whatnot. And so I write the book from this very sort of third party perspective, where I tried to independently and objectively analyze a whole bunch of different styles and strategies. And the goal is to help people sort of pick and choose, or find a portfolio that works for them, rather than thinking that something is some sort of holy grail. And so you hit the nail on the head. The key word there is your.
That holy grail search always comes up, and folks fall victim to their emotions, and they look for that perfect solution to the problem is the market, not the problem is their savings or their strategy or their plan. And they look at the market as this thing to beat or to outpace or
Yep.
instead of the utility of the market to help them achieve their goals, and they make more mistakes. They can
Yeah.
they get conservative at the wrong time, or they want to get aggressive at the wrong time. Or my favorite is, I was playing golf with my buddies and his portfolio did this last year. Why didn't mine?
Yep.
Or he owns this and it's doing well. Why don't I own that?
It's a
And
common theme throughout the
and
book
it's
is the grass always
yeah.
looks greener somewhere else, and people, rather than watering
Well,
their own
I was gonna
lawn
say,
in the
why it
portfolio
looks greener,
management
right?
world.
Because the other side's fed with
Yeah.
crap.
And people so often, they don't tend to their own lawn, and instead what they do is they think that, "Oh, I can just jump into somebody else's lawn,"
Right.
and lo and behold, a lot of the times when you do that, when you chase the lawn that looks green, you end up buying something that actually, it may be seasonally, it's on the verge of turning brown, and you realize, then a few years later, "Oh, crap, now I'm in another, brown-looking strategy here," and so, performance chasing is a big, big problem, especially, for financial planners and
Yeah.
advisors. And it's one of the things that I talk about, that there's this inherent conflict in a lot of ways between the way that the investment management world sells strategies and the way that financial planners and advisors think about the portfolio management world. Because if you walked into a good financial advisor's office, they will never tell you that beating the market is the primary goal of what you should
Right.
be trying to do. We would all love to beat the market. I'm not saying
Sure.
that you shouldn't try to generate high returns and low levels of risk, but at the same time, the main goal that a good financial advisor will have for you is that you should have certain amounts of money to be able to do certain things across your lifetime. And that could correspond to generating very high returns in certain components of your portfolio, but it may also correspond to willingly choosing that you're going to manage something in a very conservative way where you know that you're not going to beat the market. I mean, for instance, with let's say an elderly person who has, health concerns, they're drawing down their portfolio and they don't have the capacity to take large amounts of risk. Well, beating the market is irrelevant to that person. That person has to accept the reality that they need to implement something that is inherently conservative, that is going to help them navigate all the uncertainty of the short time horizon they have. And so that's a good planning based process where you then have to plug and play the appropriate types of strategies to match that underlying plan.
Right. And that's, we designed for our client process is called our navigation formula. I'm glad you used the word navigate there because we're helping folks get from point A to point B.
Yeah.
And what is going to help get you from where you are to where you would like to be ultimately is it's not just beating the market. It's generating the returns that matches your savings rate to help you and get you to where you'd like to be. And if we can do that by eliminating risk and being a lot more conservative along the way, that's got to be a victory for folks that, now you don't have to worry. Yeah, your portfolio only did this, but your buddy on the golf course, what did he sleep last night?
Yeah.
Because
That's the thing.
was he worried about the risk?
I interviewed William Bernstein in the book, and he had this great quote where he said that the suboptimal portfolio you can stick with is always going to be better than the theoretical optimal portfolio that you can't. And what
Yeah.
he's basically saying there is that there's always this theoretical optimal portfolio out there that looks like it generates really high returns with very low levels of risk. And the problem with those sorts of strategies oftentimes is that they will test you. And when they test you at times, let's say that, you're buying some sort of like, artificial intelligence mag 7 type strategy right now that you've run the back tests on, and it looks like it generates, 20% a year with lower levels of risk than the S&P 500, and you buy into this thing, and then it falls 50% at some point, because it's going to fall 50% at some point in all likelihood. And
Right.
it's got that sort of standard deviation or volatility in it. And what that does is, this theoretically looks very optimal in a back test. And when you actually live the experience of it, it feels suboptimal from a behavioral perspective for a lot of people. And a lot of people won't be able to stick with that. And what they find is that, hey, if I had actually implemented something more conservative, like one of the chapters I write about is the 60-40 portfolio, 60% stocks and
Yeah.
40% bonds, which is a fairly plain vanilla portfolio, but we call it a balanced portfolio because it creates a lot more balance in the way that it generates its returns over time. And what people will oftentimes found is that, hey, if I had been a little bit more conservative, and even though this is portfolio is theoretically, suboptimal compared to that theoretically optimal portfolio, I would have stayed the course with that one. And I would have
Right.
generated better returns on average over the course of holding that thing than I would have if I had tried to stick with this theoretically optimal portfolio that really tests me from a behavioral perspective.
Yes. And I think and I don't think our peers, I know we don't sell our services this way. They think their financial advisor is going to be able to trade at the correct moments every time.
Yeah.
And we won't. I mean, that's the only certainty is that we're not going to be able to do that.
And that's almost part of the goal, actually, is that another great quote in the book is from Brian Portnoy, who says that good diversification is learning to hate some part of your
Yeah.
portfolio all the time. And that's that's a hard thing to stomach, I think, for a lot of people, because you can go through these periods where part of your portfolio looks really crummy and people will look at it and they'll say, I hold these intermediate bonds or something, and they have been a drag on the portfolio for the last few years. What are we doing with these things? Why do we own
Right.
this stuff? And the reason is because if the stock market ever, the rest of the portfolio or, whatever it might be, when that other part of the portfolio at some point starts to perform really poorly, there's a strong probability that these other safer instruments might be performing really well in a relative sense. And so there's a ballast in there in a good diversified portfolio where, yeah, it's not all going to be performing great at the same time. And in fact, part of the point of it is that when you have a diversified portfolio, you really don't want the whole thing to be performing the same way
Right.
all the time, because it means that when things boom, your whole portfolio is going to boom. And when the thing busts, the whole thing is going to bust. And that is going to be a moment where you wake up and you say, this doesn't work for me because I can't
Right.
stomach all the
What was I
downside here.
thinking?
Though
Yeah.
that's the point of good diversification, is that you've got to really be building a diversified portfolio that it insulates you from any sort of extremes, both on the upside and on the downside.
Yes. And that's the one quote that stuck with me out of the book was if your portfolio is moving in the same direction at the same time, you don't have diversification. And I like what you called that section or chapter. Diversification is the only free lunch
Yeah.
because
Yeah. So I
it's
have there's 10, the way the book is structured, just so people kind of understand, there's 10 basic principles I go through. It's really, the book isn't even something that you don't necessarily have to read it sequentially. It's kind of like each chapter is almost, and the two different parts are kind of their own little books in lots of different ways. So
yeah.
the first 10 or the first part of the book is 10 essential principles, and they're kind of the main building blocks, the most essential components, I think, for understanding good portfolio construction. And then part two, I go into 20 plus different specific strategies where I break each one down and I discuss the history of it, the pros and the cons, and I talk about, this is who this portfolio might be good for, this is who this portfolio might be really bad for. And so it's really a sort of a discovery process of understanding the, not only the core building blocks of portfolio construction, but then actually understanding the way that a lot of famous investors and a lot of just famous different strategies work, and trying to assess, hey, this could work for me, or this could work for my Roth IRA, or this could work for my taxable account, and kind of picking and choosing different sorts of approaches that might work for you.
Yeah. And the first part is, I think, I mean, that's the way you broke that down and is the true gem without getting too deep into the strategies section. First off, the first chapter is you're a saver, not an investor. To me was really eye-opening. I'd never really thought of it that way before. But when you think about the folks that you and I both work with, they've known enough to save.
Yeah.
They've known enough to accumulate and to be disciplined enough to save. And they call for our help because they don't understand how to invest.
Yeah. It's a really, it's a, some people might say it's sort of a semantic, nuanced point to say that your portfolio is more a savings portfolio than an investment portfolio. But it's something that I actually think is kind of important, because I think a lot of people get into the world of investing, and they think of it as something that's more of sort of a get rich quick scheme, or something that's really sexy and, is going to really accelerate their wealth really quickly. And I think that, the reason I wrote this specific underlying chapter in the book was because 10 years ago I wrote a book, and it was a macroeconomics book more so than a finance book. And
Okay.
it's very weird. In the world of economics, the word investment has a totally different meaning than it does in the world of finance. In the world of economics, investment means to spend for future production. And this is essentially what firms do. When a firm builds a factory, for instance, they're spending for for
Right.
future production. And this is totally, totally different than what somebody does when they buy stocks and bonds on a secondary market. The person who's buying stocks and bonds is literally taking some of their savings and they're reallocating it into a security or an instrument whose value is reflected by the way the firm spends for investment. And so these are very, very different things. And even though they're related, the person who is buying stocks and bonds is not actually spending for future production. They're not investing in the economic sense of the word. They are allocating some of their savings. And so it's a very, I think from a mental approach, especially, it's a nuanced way of thinking about things where when you go into thinking about your portfolio as a savings portfolio, you enter it with a different process and a different mentality where this isn't necessarily a get rich quick process at all. This isn't something that's necessarily sexy or something that's going to make you rich overnight. It's something that is methodical. It's a planning based process. You are allocating your savings in this very thoughtful process, a planning based process. And that doesn't mean that you can't have components of this that are going to generate very high returns.
Right.
You can make a lot of money allocating your savings, but it should be a process where you're very methodically thinking of this based on a financial plan where you're then allocating things so that they match that financial plan and they match your goals and your needs over different time horizons.
Yes. Yeah, I couldn't agree more, and I think that's what gets lost in, some failed processes, maybe by our peers, that are their processes designed to sell them something, not designed to enhance their savings, or it's a process for the advisor, or a process for the firm,
Totally.
not a
It's an
process
asset
that revolves around our
gathering
clients.
process
Yeah,
or something like that rather than a true planning based
right.
process.
Because in that planning process, it's the next principle, you're your portfolio's worst enemy. I would even take that beyond your portfolios, and you become your plan's worst enemy,
Yeah.
and irrationally spending, or wanting to irrationally pull your money out of the market, because things get volatile, and that happens. It's going to happen, and
Yeah.
anybody that thinks it's not going to happen is fooling themselves. But I can't tell you the last time I got a phone call with somebody asking me about investment performance. They're always asking about planning questions.
Yeah.
When can I retire? How is this going to affect my income? Can we buy the second house? What are we going to do if we run out of money? What are we going to, how should we be save? Everything's a planning question. And I still see the same follies disrupt their plan there, is that happens with the portfolios.
Yeah. It's not I mean, that's a sign of a great advisor is that you haven't set expectations in a way where it's a performance chasing
Right.
adventure. And the client who understands that and has an understanding of the realistic expectations and the real goals you're trying to achieve for them, they know that, yeah, performance matters, but
Right.
performance is not the benchmark for whether or not you're achieving your financial goals. And people get into this and I think they become their own worst enemy. So principle number 2, like you said, is you are your portfolio's worst enemy. And this is actually a famous Benjamin Graham quote. And it's really about setting expectations and having the right goals. Because when your goal is just, I want to make as much money as possible, what you'll oftentimes find is that what you end up doing is you're not just chasing returns, you're chasing risk. And
Right.
if those risks are inconsistent with your financial plan or your goals or your behavior, you're going to fail. You
Yeah.
become your own worst enemy. And like we said, that theoretical optimal portfolio, it starts to look suboptimal in the back of your mind. And all of a sudden you start thinking about, I need a portfolio divorce. I need to change something here. And you start chasing you abandon your portfolio at the worst
Right.
possible time and you start chasing some other fancy looking shiny rock.
Right. Because sometimes it's hard to not abandon sometimes.
Yeah.
You think back to 2008 when you hit the bottom of the market. The best advice was to tell folks to invest in stocks. And they looked at you like you had a horn growing out of your head because of what the market had just done. If Macy's would have had a 50% off sale, you'd be banging on the doors to for them to let you in.
Yeah. I
And
use
the
that
market
quote.
was
I
doing
say
the
in the
same
book,
thing.
the stock market is the only market where when things go on sale, all the people run out of the store.
Yeah. And the stock market buys the sweater for you in some cases because, beating the market is hard. I mean, the principle 3, it's hard. It's really hard. I don't know. I would be a lousy advisor to sell performance only because I wouldn't be able to stomach trying to beat the market. As an asset manager, there's no way I would convince anybody that I could do it, and I'd make myself sick to my stomach trying.
Well,
It
it's
just
crazy
would be
too, because, even if you're, as advisors, we probably spend the majority of our time, or we should spend the vast majority of our time on planning needs and fielding
right.
questions about, required minimum distributions and Roth, conversions and things like that, more planning based parts of all this process. But it's interesting that, even the guys who are the actual portfolio managers on the investment management side, I mean, the failure rates for these guys against
Oh
the
gosh, I
the
can't
indexes
imagine.
are just the numbers are atrocious. I mean,
Yeah.
I put this in one of the tables in the book is it shows that over a 20-year basis, 94% of all domestic funds underperform their indexes. 94%. So that
Right.
means that, there's 6% of people out there, and you can maybe some of this is skill, or is that 6% luck? We really don't know. But the
Right.
point is that I think a lot of people don't really understand just how incredibly hard it is to consistently beat the market, especially, and this isn't even assessing like the most damaging things. If you did this on an after tax, after fee basis, after inflation basis,
After
add in
yeah,
all the real costs
inflation,
that we
taxes,
incur,
fee, right.
the numbers are probably even worse on an after,
Sure.
I use the term real returns throughout the book a lot. And that's thinking of things in our real capacity to spend, which is you got to back out inflation, you got to back out taxes, you got to back out all the fees that you're incurring along the way. Those numbers are way lower than what you hear a lot in the financial media, where, a lot of people talk about how the stock market does say 10% a year. The stock market does 10% top line. The
Right.
return that you actually eat is much lower,
Right.
probably closer to like 4 to 5%. And a lot of people don't assess that in a real return basis. And so it's really hard to beat the market. And so not only is this not necessarily a financial goal that any of us should be setting, but you should know that even if you're setting that as a financial goal, the hurdle is humongously high.
Yes. Well, that and if you're busy families and active retirees are searching for help, if you're sitting in a conference room listening to a strategy pitch or something and they're telling you, well, we beat the market, it's probably a good time to, just get up and politely excuse yourself because you're chasing the wrong mechanism.
Yeah.
And the one paragraph that you wrote here right before you talked to William Bernstein, when you said, instead of trying to win, you should try to formulate a sound financial plan and then apply a strategy that matches that plan and your needs over time. Don't worry if your strategy isn't consistently optimized to beating the market, because perfect is the enemy of good. And then this is nowhere more applicable than in portfolio construction.
Yeah.
And that's to me, that was a great excerpt to listen to there, because the book's called Your Perfect Portfolio, and your perfect portfolio is what's helping you navigate towards your goals, not
Yeah.
what is beating a benchmark or a market or something.
Yeah, it's funny because some of the early feedback on the book is from people who are a little mad that I didn't give them just one recipe. Um,
Right.
but that's the whole message of the book, is that there
Right.
is no single recipe that we all love that is gonna taste
Right.
the best for all of us all the time. It's that you've got to find the thing that works for you. And
Right.
and the other thing is, I love the name of this podcast, because money on the move it communicates that money changes over time. Like I
Yes.
talk about a lot in the book about how there's nothing, you can't really say that anyone is a fully passive investor in a true sense. And I try to model this out using one of the specific portfolios in a later chapter. But the main message is that things change over time. And that's another aspect of this, is that you can't just take one strategy and then plug and play it and think that this is going to solve all of your problems across your entire life, because it's not going to, in large part because your needs are going to change over time. You're going
Yeah.
to, like, the thing that lopped me over the head was when I had my first daughter, and it threw everything up in the air for me financially, because before I had any kids, my risk profile was really simple. My time horizon was really simple. It was
Right.
me and my wife, and we could think really long term, and it was really simple because we could just be aggressive. We're young, have good incomes, and so we had this risk capacity that was really high. And then I have a daughter, and everything changes, because now I have to start thinking about, God, I need life insurance. I need to think about 529 plan. I need to think about, how am I going to spend for daycare and, diapers and all these things that, I never needed before. I need to start thinking about multi-generational needs. And so kids introduce something that is really interesting into your life, because they introduce lots of different time horizons, where all of a
Right.
sudden you have to start thinking about things across all these different time horizons, because you're going to want to pay for college. You're going to want to pay for daycare. You're going to want to pay for, I want to leave them some money, hopefully at some point in the future, if
Right.
I can. And so you have to start thinking about
And then,
all these
God forbid, they get into something like youth sports, or
things.
get a hobby that's expensive.
Oh my
My
God. My
oldest
kids
son.
aren't there yet, but I hear some
Well,
friggin'
see,
nightmare stories
my
about the
my
youth
oldest
sports.
son is really not into sports. I would rephrase that. He loves sports. He doesn't like to play them. And I was like, all right, we're going to save a few bucks. And then he says, Dad, I really like photography. A
Oh
baseball bat's a
man.
lot cheaper than a camera, buddy. The one thing that you said that, and again, what we try to do when you were talking about the title of the podcast and wealth moves, I've been in this profession for 23 years. I have some clients that have been with me for 23 years. And 23 years later, I know, I don't even know if they recognize this. Their plan looks nothing today like it did 23 years ago. Their
Yeah.
goals don't look nothing like they did 23 years ago. And that was a catalyst to, not just a podcast, to our process, was we're navigating. This is not
Mhm.
a point A, point B, straight line, rotating circle that is just an infinite wheel that we're regurgitating the same thing. No, we have to reroute. We have to, you know, take the scenic route sometimes, or take advantage of the ability to have those different opportunities or protect against different risks. It's wild how thinking today you're going to buy something that's going to work even so long as 5 years from now or a decade
Yeah.
from now is it just
It's
it
part of what
isn't
makes the financial planning process really somewhat difficult too, is that you you have to make estimates about what things are going to look like in the future to some degree. And
right.
so there is this inherently predictive and forecasting based aspect of good financial planning, where you have to go into the whole process where you're trying to predict, well, what is inflation likely to be, or what is the stock market likely to generate over the course of the next 20 years? And there's a lot of guesswork. I think there's lots of stupid ways to do the guesswork, and
Right.
there's pretty smart ways to do the guesswork, but it's part of what makes all this so hard. And so, I try to emphasize that, especially inside of my process, is that you mentioned that inside of the 5-year time horizon, I really love thinking about things I implement sort of a bucketing strategy for my
Mhm.
own business, but I love thinking about things in these very segmented time horizons, because you can especially take down that 0 to 5-year time horizon, and you can, I think, with a pretty reasonably high probability, you can predict what those time horizons are going to look like. I mean, I know more or less what my expenses are going to look like over the course of the next 2, 3, 4, 5
Right.
years in all likelihood. I really have no idea what they're going to look like in 20 years. They could be completely different. Who knows? I could have some sort
Right.
of health scare that makes everything completely thrown out the window in 15 years. In the 0 to 5-year time horizon, I have a pretty high probability of being able to predict what my expenses are going to look like in there. And so I can make pretty reasonable guesses about, well, this is what my expenses are going to look like. And so I kind of know like if I start blocking out certain pools of money for certain needs, or especially if you're going through processes like I'm going to buy a house in the next 2 years, or I need to buy a new car in the next 18 months, you can then start to think of things in a very sort of systematic and quantified way where, okay, well, if I need a new car in 18 months, well, I've got to have, who knows, $50,000. That money can't be in the stock market because
Right.
I don't know what the stock market's going to do in the next 18 months. That money's got to be allocated in a different, much more structured manner where the probability of me having that $50,000 in 18 months is 95%
Right.
plus. And so you can start thinking about these things, not just in a very planning based process, but also in a sort of a temporal structure where it adds a lot of certainty to the financial plan, where you can then look at things and you can say, well, actually, I don't care what my super aggressive Roth IRA is doing because, yeah, sure, the stock market is down 50%, but you know what? I allocated my $50,000 to buy that car, and I know that that's there. It's in a safe instrument where I'm not worried about what the stock market is doing because I've covered my financial needs inside of these shorter time horizons where I know I can navigate my short-term expenses and liabilities in a way where I don't need to be too worried about what the long-term stuff is doing.
Yeah. So I wanted to ask that question. You call it asset allocation a temporal conundrum
Yeah.
in Principle 8. Can you dive into that a bit more?
Yeah, so I talk a lot about time in the book and how our financial lives are really they're a sequence of different events that occur across time. And so we're all here for a finite period of time and we're all trying to navigate the best way to go through this with the highest amount of predictability. And I love there was a Ken French quote in the book where he says that risk is uncertainty of consumption. And there's lots of, in the financial world, there's lots of different definitions of risk. Some people, academics will call it standard deviation or
Mhm.
volatility. Some people might say that, Morgan Housel says that risk is what we don't know. And these are all applicable and useful definitions for what risk is. But the biggest risk that we all encounter is that we're not going to have money to do the things we want in the future.
Right.
And that's the main process that good financial planning tries to solve for is it's a process of, am I going to have enough money to retire when I'm 65? Am I going to have enough money to buy a house, in 5 years when I want to? Am I going to have enough money to send my kids to college in 10 years? And those are all they're all temporal conundrums. They're a time-based problem where you have to try to solve for planning not just your financial plan, but your asset allocation in such a way where you can then begin to quantify, okay, I have a pretty high probability. I mean, I know that, to use a really simple example, if I'm 25 years old and I have a pretty decent income and I'm planning to retire in 40 years, well, I know that my Roth IRA and my 401k should probably be pretty aggressive, maybe like
Right.
max aggressive actually. And if I do that, if I hold on to those instruments for, 20, 30, 40 years, there's a very, very high probability that X number of dollars will turn into Y number of dollars based on a certain percentage return over the course of that very long time horizon. And so you can start to think of things in this very time-based perspective where, on the other end of the spectrum, if you're someone who is, like I talked about earlier, if you're 85 years old and you've got health concerns and, you've got a shorter time horizon and you're worried more about, can I cover my healthcare costs over the course of the next 5, 10 years with a high level of predictability, that person's asset allocation is completely different
Right.
because their temporal conundrum is completely different than the young person with a long time horizon. And so that person needs a very different structure inside of their asset allocation where they're probably structuring things in a much more conservative way, where they're utilizing instruments that have an inherently much shorter time horizon, where the instruments have a lower expected return, but the instruments also have a much higher degree of principal stability inside of them, where they give that investor a very different understanding of how they're going to be able to achieve those goals across very short time horizons and give them, peace of mind that, hey, I'm going to be able to pay for these healthcare costs over the course of the next 5 to 10 years without having to worry about, is the stock market going to crash and blow up not only my portfolio but my ability to consume in the future.
Yeah. Well, and that's with kind of mentoring Nico, a younger advisor in our office, when folks are upset about their portfolio or scared about market losses, they're not scared about market losses. They're scared about that lifetime of consumption.
Yeah.
If I lose this, I can't do this later. And I mean, listen, nobody wants losses. Nobody invests with the with the hope of losing money. But it's not the losses that are triggering the emotions. It's what those losses signify.
Yeah.
And taking that into, if you're working with an advisor, taking that into consideration when you're having these conversations. When someone says, well, I just don't want to lose money. Well, no kidding. Who does? Nobody came in
Right.
here this week and said, you know what, Will, I be all right if I lost 20%. Nobody said that. Okay, but why? Why don't you want to lose money? What are we trying to make sure that we're funding, that we're protecting for, that you want to do? Because you want to go on this luxury vacation. So if I lose money, I don't think I can go on that trip anymore. Okay, now that makes sense, because nobody wants losses, but what are we anchoring those losses to, or not being able, your ability to do them?
Yeah, it's funny because I mean, a lot of the risk profiling processes that we go through they're so subjective. And like I laugh because I used to send out this risk profiling form where one of the questions is, how do you respond to a 30 or 40% decline in the stock market? And it's funny because 95% of people will answer that question the exact same way
Right.
because they know the right answer. But the crazy thing is, people will always say, well, I stay the course. I would never sell into a big bear market. I know that's not the right thing to do, but
Yeah,
the
right.
psychology of it is really interesting
Right.
because when you get into a 30 or 40% decline, you look at it and it all feels totally rational in the moment. And you're looking at that environment and you're saying, well, holy cow, the market is down 30 or 40%, but what if we're only halfway through all of this
Right.
and the market is on the verge of, eventually falling 60 or 70%? One of my favorite charts in the book is a chart of the Great Depression. And the Depression is horrifying because it was this from 1929 basically to 1932, the market just fell almost every single month until it eventually reached a max drawdown of 80%. And so you had 3 years of just this persistent, like, I mean, just the most painful sort of selling that you could
Right.
really ever imagine. But I think that's the psychology that a lot of people go through, is that when you're in a moment like, especially like COVID, where something that we'd never seen a
Right.
global pandemic. And so people are seeing this thing that the market is reacting to, and it all feels very rational in the moment. And you're saying to yourself, well, wait a minute, maybe I do need to be paring back my risk because, like you said, they're not actually scared of what the stock market is doing necessarily. They're scared of the realization that, hey, if this persists for a lot longer, I'm not going to be able to consume the things that I want to in the
Right.
future because I'm not going to have enough money to do that. And so what people really do when they sell into a big bear market is they're not just selling stocks, they're specifically buying cash. And they're buying cash specifically because cash is the thing that gives them certainty. So they're solving that uncertainty by buying cash. And then they can, they're out of the stock market position, and they can look at their portfolio and say, okay, now
Right.
I can sleep
Now
at night
that what
because
is a
I've got
sigh of relief,
certainty.
right? Yeah, that I'm glad that's over. And unfortunately, a lot of folks do that at the wrong time,
Yeah.
and it can be damaging because now it's a recovery, and then you don't, managing through the financial crisis, you didn't really buy the fact that it was over when the
Yeah.
market started to recover, and you get into 2009, and you're still happy to hold cash even though the market's ripping back up. And in 2010, you still don't fully, you're not committed to the fact that it's over. And, the media doesn't want it to be over because the financial news channel sold a lot of airspace from 2008 to mid 2009. And then every graph I just pulled up the chart that you were referencing in about the Great Depression. There was a lot of run ups in the middle of run downs,
Yeah.
and you don't fully buy the fact that it was over. And and then you've missed it, and by the time you've convinced yourself that it's safe again, it's 2011, and the S&P downgrades U.S. debt, and we are again on another volatile cycle, and you become your own worst enemy.
Yeah. And that's
Um,
part of it is there's another chart in the book about, all the trials and tribulations that the stock market has overcome over the long term.
Right.
And
There's
there's always
always a reason
yeah,
not
there's,
to invest.
there's always a reason to be scared. And
Yeah.
so, and the financial media doesn't help a lot because they're, they almost have their own weird conflict of interest too, where they're selling airtime. They
Right. They're not there
want
to
to
help.
grab
Right.
Yeah, they wanna grab eyeballs. They wanna jump on the most, exaggerated and hyperbolic news of the day. So rather than, like I oftentimes make the joke that an honest day in the financial media would be, well, about 200 million people went to work today, and they more or
Right.
less did the same exact thing they did yesterday, and really not that much different from yesterday happened.
Right.
But instead of that, what they say is, the stock market was down 0.5%, but inside of the stock market, Intel fell 25% and gold was up 15%. And they sort of cherry pick,
Sure.
the most extreme hyperbolic elements of what happened inside of a pretty mundane day. And the reason they're doing that is because they want your attention. And especially in fear-based environments, I mean, that is like the holy grail for financial media, where they can really latch on to your fear, because the fear it's the most powerful emotion
Hmm.
that anyone can grasp. And when someone can scare you, they can convince you to do things that are really, really bad for you, like probably, watching a lot more financial media than any of
Right.
us should. And
Well,
so,
I mean, just look at, the mission has become not to build the better mousetrap, but to build a scarier mouse.
yeah,
And I mean, I don't think any politician is innocent when it comes to that. They never talk about, these are my ideas to do things. They talk about how bad the other person's ideas are.
yep,
And they're trying to, instead of build the better mousetrap, make the other person scarier, so that you end up voting against something and for nothing.
yep,
And the market is no different now. There's a financial media. The bigger the scarier mouse we can build, the more that you're going to watch, the more ad space is going to go for. It's always, breaking our regular scheduled program for markets in turmoil, and scaring us worse than
yeah. I talk about
imaginable.
that a lot throughout the book. Is that, like I mentioned, that one of Warren Buffett's real superpowers is that he's agnostic to these emotion
Right.
based moves in the market, and being politically agnostic too in your portfolio, I think, is super important. I mean,
Yes.
I have, over the course of my career, just fielded an ungodly number of political questions
Right.
where I'm constantly telling people, I don't care what this politician said. I don't care that they shut down the government again to make some sort of short term, political noise and banter. And it's irrelevant to your portfolio in the long run and your goals. And so, ignore the
Right.
politics of all this, because there's so much behavioral
When
bias
it's
in
it's
all
so
of it
funny
that,
that when the election results emerge, for every call that's excited, there's another call that's concerned.
Mhm.
And for everybody that wants to buy more because their guy won, there's somebody that wants to sell everything because that guy won. It's very I when folks say they do this themselves for themselves, I always am concerned because of that. You're succumbing to your narrative and your bias, and you may be unhealthily anchoring yourself to these limitations. That's why you can't sleep at night. It's not
Yeah,
because the market's doing it, it's because you're anchored to something that doesn't exist, and
bingo.
you're putting your money at risk. So
Yeah.
for folks that are doing themselves and want to dive more into your book, where can they find it?
Well, the easiest place obviously is Amazon. I do have a Your Perfect Portfolio page on our company website at disciplinefunds.com. If you Google that, it'll come up. There's a URL in the book that leads to that. And but but yeah, I mean, I would say in any, I don't know if people still use physical bookstores.
I you know, I don't know. My Amazon brought mine in 24 hours, and I was able to dive into it immediately. So,
Yeah,
um,
I'm sure you can buy it online at Barnes and Nobles, or any physical
maybe
bookstore. But yeah,
okay.
Amazon.com is going to be the best place
Okay, and we'll make sure we
to
put
get
that
a
link in
copy.
our show notes too, so our listeners can find that and check it out. I'm excited for our listeners to hear this. If do you are you active on social media? Can our listeners follow you anywhere there?
Yeah. I'm way too active on Twitter. So,
You're the
it's just
first guest that said they're really active on Twitter. That's or X now, I guess is what it's called,
yeah.
X.
Yeah. I guess we're changing the name of it, huh?
Yeah.
Um,
What's your handle so folks can follow?
it's just my full name,
Okay.
one word.
Okay. And as always, if you
So
have any questions, you can reach out to us at hoffmanwealth.com. I'm very active on LinkedIn, just under Will Hoffman, my name. But yeah, check out Cullen Roche's book, Your Perfect Portfolio, to see maybe what psychological biases or limitations you've been maybe applying. And if there's anything you'd like to put into action, please reach out to one of us. But until next time, like we always say, keep your wealth moving.
Cullen Roche and Discipline. Funds are not affiliated with Hoffman Wealth Management and Private Advisor Group.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.